PSU Banks. Trideep Bhattacharya from Edelweiss Mutual Fund is now joining us on the show. Trideep, the big question is, will this two-day rally fizzle out over the next few days? Because Q2 earnings were disappointing. There is a lot resting in terms of the earnings recovery. We've seen some downgrades. Or do you think this mandate, we will, because of this mandate, this resounding mandate, we will see a big capex push, and that should help this rally being a little more long-lasting, a little more durable?
Yeah. Good afternoon. Thanks for having me on your show. I would put it like this, that the earnings pause that we have been seeing in Indian markets for the last 2 quarters, not just in Q2, but also in Q1 and Q2, is driven by a lot of lack of decision-making from the government and also some weather conditions and a few others, which I think post the political mandate that the ruling party got in Maharashtra, it gives a bit of a solace that in the second half of the year, the government and the authorities would be back to decision-making, back to the capex drive, and hence in the back half of this year, we would see earnings upgrades coming through. The whole reason why the market was correcting was because there's been an earnings cut of somewhere between 5 to 7% in first half of this fiscal year, which I think will reverse in the second half of this year. So immediately the markets will do what it will do in the very near term. But I think over the next 2 quarters, I do see some bounce back coming through on the back of some rebound in earnings that we missed out in the first half of the year.
Okay, all right. Hi, Trideep. Good afternoon and good to see you in. So what do you buy? What's your top sector that you're bullish on?
So basically, over the last 3 to 6 months, we have added to IT. We have added to rural part of the consumption, which I think is yet to play out, will most likely play out in the back half of the year. And third, financials, particularly private sector financials with sort of strong liability franchise. These are the 3 areas that we have added. And the final thing I would add is real estate. So these are the 4 areas that we have added on the back of either price action, which has been down, or for that matter, our relative conviction that earnings will bounce back relatively stronger as we get towards the back half of this year.
Okay. All right. Trideep, hi. Good to see you here. So, we've just been discussing this whole buzz around quick commerce, and it's hard to ignore, right? Because there's just way too much going on in this space. Quick commerce / food delivery, basically new age platform companies. Now you have 2 to choose from. And then you have a whole host of other internet businesses as well. What thoughts here?
So my sense is that quick commerce left on its own will cause disruption in the consumption retail space. The reason I say left on its own is because at some point you might see regulation or governments coming in to kind of think about the welfare motive of the traditional retail and the mom and pop stores. But barring that, the business proposition of quick commerce, and particularly some of these do really make money. So there's a strong business proposition as well, remains quite strong. So on its own, I would kind of prefer the quick commerce, particularly in the urban market, if you ask me. In the rural market, still there is room for traditional retail to really come through. We ourselves are betting on some of these names in our portfolio meaningfully, and we think they will do well over the medium term.
I got that. Trideep, just a quick word on, your, I don't know if you own these city gas distribution companies, your IGL and MGL. Any thoughts at all? I think you don't. But your view?
About a couple of quarters ago, we sort of took a view that it is better to sort of stay upstream when it comes to oil. Structurally, we had have been negative on oil and oil-related sectors. That's one of my biggest underweights in the market if you sort of look at it versus that of other sectors as well. I think by and large that has played out. Some of these things with regards to gas, the APM cuts and whatnot, though not fully anticipated, but it was a kind of it was worked in direction with regards to where we are, where we are actually betting on the other side of it, where we think that overall, this might, given in the regime where populist measures are kind of gaining a bit of popularity overall across the country, we might see net on the other side consumption, particularly rural consumption, might actually see some boost coming through in the second half of this year, given better monsoons, better harvest, and hopefully kind of a better half of the year with regards to weightage relative to the full year. So we are betting on the other side of the basket, which is the consumption, rather than the commodities side.
What about real estate? What's driving your upbeat, bullishness on real estate? And which one are you betting on? Pan-India players? Is there a regional bias?
So basically, I think we are in the middle of a 5 to 7 year upcycle in real estate. And this is driven by the fact that if you look at housing unsold inventory across the country, it is still at meaningful, close to 10-year lows. That means hardly any inventory in the system augurs well for the overall sector. This is, of course, after a decade of consolidation and regulation that we have seen. The other part that might come through is if interest rates do really come back a little bit in the new calendar year, then they would stand to benefit. The third area that I would say that because of price action driven by the fact that the intersection benefit was taken away, we got some of these shares actually relatively inexpensive versus their own past in the past year or so. That also prompts the action. Real estate has two components, direct and indirect. Direct, i.e. the builders, indirect, i.e. the building materials. I think the entire chain over the next 2 to 3 years might actually see better days ahead, even though they have done relatively better in the past as well.
You mentioned consumer, Trideep. Just expand on that, because that's where there's the big debate, right? That there has been a slowdown, there's a problem with urban demand, but you still have stocks like Trent and Indian Hotels in your portfolio. And I mean, to be fair, they've been reporting great numbers as well. So what do you forecast? Right now, it is still financials and I think capital goods. I was looking at some of the strategies like the mid-cap fund or the flexi-cap funds. Financials still get top billing. But what exactly are you sort of planning on consumer, and what do you like here?
Yeah. So within consumption, basically, our orientation is more toward discretionary than staples so far. That probably explains some of the names that you mentioned as bigger proportions of our portfolios, and they have done quite well because we think the luxury end of the spectrum and over a period of next 6 to 12 months, the rural end of the spectrum will actually do well. Everything in the middle, which is urban consumption, or for that matter, the lower middle class in urban basket, or basically the middle income, so to speak, basket, might actually see a bit more of pressure going forward. So barring that bit, we are overweight on the others, which is by and large, this barbell approach has by and large worked with us. We think as we get to the second half of this year, with more auspicious days, whether we call it wedding or more occasions generally, we think that earnings will actually gallop in the second half of this year of some of the companies, particularly in the discretionary side, that will kind of that are exposed to that. So that's well. I also think that FY26 would be a decent year for consumption as well, given the low base that we have been seeing for the last couple of years. So maybe it takes a bit of time to play out. But consumption is one to kind of for the next 12 to 18 months we are keeping an eye on.
All right. Trideep, we'll leave it there. Thank you very much for joining us. Good speaking with you, and a pleasure having you here on the channel this afternoon.
For more news and updates, all you need to do is follow CNBC TV 18 on all of our digital platforms.